Welcome to This Week in Money. I'm Phil Mackesy. Today, Marc Faber says, watch out below, we could have a market pullback. And Jack Crooks looks at the Fed's latest moves. We begin with Marc Faber right after this.
Randy Elvis Frisky and his Las Vegas show band 40th anniversary Aloha Tour. February 23rd in Penticton. February 24th in Vernon. On sale now. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Marc Faber is editor and publisher of the Gloom, Boom, and Doom Report. It's an in-depth economic and financial publication which highlights unusual investment opportunities around the world. He's online at gloomboomdoom.com, and you can also follow Marc on Twitter at gloomboomdoom. Hey, Marc, welcome back to This Week in Money.
Well, it's my pleasure. Thank you.
Latest G20 meeting is over. Central bankers and politicians are saying that they're going to refrain from competitive devaluation. It sounds terrific, Marc, if we could actually believe it, right?
Correct. I think most countries will pursue policies that are essentially trade restrictive, either through exchange rates or maybe even import duties or export duties and so forth. So I think the competitive devaluations will continue, as has happened in the case of the Japanese yen.
Now, the yen is in the spotlight this morning. What's happening there?
Well, basically, the Japanese believe that part of their problems is a yen that is too strong. So they want to depreciate the currency, and I think they can succeed, but they have to print a lot of money. And what it will do, it will eventually increase the interest rates in Japan and on the Japanese government debt, and bring about a new set of problems.
Now, what's the simplest way out of a situation like that? Is there any smart thing that they could do to stop this kind of thing happening?
In my opinion, we have a global economy. Some parts of the global economy are hardly growing or contracting. Europe, the U.S., whether it's growing at 2% or contracting at 2%, would depend how you measure the cost of living increases. In other words, the personal consumption expenses indicator or inflation, and Japan is in recession. So the rest of the world is unlikely to grow very much either. It can probably grow at a faster pace than the developed countries, but all the money printing that is going on may actually aggravate the problems. And in my view, we have a dichotomy between the performance of equity markets, which have been very strong, and the real economy of the man on the street, whose economy is basically in distress.
Marc, ties into something you have pointed out before, that our central banks have painted themselves into a corner. They have to keep printing or asset prices are going to fall. But as long as they keep printing, it's going to take a toll on the global economy.
Yes. But even if they print money, assets can decline. I mean, in America, you take, say, the year 2000 to today, 12 years, we had a bubble in real estate, by the way, also in Canada.
Sure.
And then despite of all the printing of money after 2007, in particular in 2009 and so forth, the real estate market continued to decline. It's bottomed out now in the United States, but will it go up and back to the previous high levels? I very much doubt this. So no matter how much money you print, asset markets can still have downside volatility.
You've got a pretty dire warning here, Marc. You're saying the party is over and markets are going to punish the interventionists and the Keynesians as well.
Yes, I think so. I mean, markets have always punished central planners and interventionists and central banks. They are more powerful than the interventions. The question is, when will it happen? Will it happen this year or in 5 years' time? But I'm convinced it will happen.
Marc Faber, our guest here on This Week in Money. And let's talk about the stock market. It's kind of the focus of our attention these days. I love this quote from you that says, we'd be better investors if we stop worrying about what markets will do and just relax. While we read a sampling of Marc Faber headlines here, better enjoy the market rally while you can. Global equities may see a correction ahead. Stocks set for a possible repeat of 1987. I got to tell you, Mark, I'm not feeling very relaxed.
Well, it depends. I mean, if you participated in the bull market of 2009, March 2009, to today, in the U.S., the S&P is up from 666 to over 1,500. And in Asia, we have many markets that are up 250%.
Sure.
So they had already a huge boom. I think that is something that many investors miss to understand. The bull market has been very powerful already for the last 4 years. We're going to be reaching the 4th year anniversary on March 6, 2013. So by any standard, this is a long bull market. And my view is simply, we don't know how the world will look like, but stocks are no longer that inexpensive. They had a huge run. The global economy is hardly recovering, and we could have a significant setback on any bad news.
Okay.
Now, people ask me, well, what will be the catalyst for the markets to go down? And my response is this. In March 2009 in the U.S., nobody could see why markets would rally by more than 100% over the next 3 to 4 years. In Europe, a year ago, when the markets of Spain, Italy, Portugal, Greece bottomed out, nobody could see why they would rally because the news was this negative. And now everybody says markets will not go down because the news is good, and we can't see any reason for the markets to go down. That's always a dangerous situation when people think that there is no reason for markets to go down.
Now, Mark, how can I stay relaxed if you're predicting a correction?
Well, basically, we have very volatile asset markets, whether it's gold or equities or bonds. I mean, bonds, the yield on the 10-year Treasury has risen by more than 30% from last summer. It's still very low at 2%, but it's risen 30%. And so bonds were not a good investment over the last 6 to 8 months. And we have many commodities that have declined already very substantially, and some have recovered and so forth. So if people believe that equity markets will go up by 20% per annum every year, they are in fantasy land.
What reminds you about 1987 when you look at the current market, Mark?
Well, basically, in 87, the market started to rally. I mean, it had rallied already from 1982 onwards, from the lows in 82. And by 87, stocks were already overbought, but the market still rallied 41% until August 25th. And then it lost 40% in 2 months. And my scenario is either we will make now a more significant top in asset markets. At the time, everybody thinks that the only way to make money is to be in stocks and out of bonds and cash. Or we continue to rally, maybe after a brief correction here in March, and continue to rally until the summer of 2013, and then some bad news hits, and the markets really drop sharply, which would be a very, very big problem for the central banks, because at that time the economies may still be weak, and stock markets collapse, and interest rates are already near zero. So what do they want to do to support the stock market? Probably they can just go and buy stocks outright.
Tell us about, Mark, when you talk about outside, you're obviously talking about emerging markets, a good way to avoid the influence of central bankers. Tell us about some of the places you like to invest in.
Well, it may sound strange to you because actually I'm quite negative about the entire Middle East and North African region, I think this is a huge problem developing. This Arab Spring looks more like an Arab winter time to me. But I invested some money in Iraq, in Iraqi funds, because the valuations are incredibly low. And I think in Asia we had some markets that, as in the case of Thailand, Malaysia, Singapore, the Philippines, Indonesia, these markets have gone up, say, between 150 and 250% over the last 3 years. Other markets like Vietnam and China and Japan have been very weak. So I would assume that at some point, some money that has been allocated to these best performing markets will be reallocated to the worst performing markets, such as Vietnam.
Marc Faber from the Gloom, Boom, and Doom Report here on This Week in Money. Please bookmark Marc's website, gloomboomdoom.com. Let's talk about gold. It's up a little in Asia today. It's bouncing back nicely from that low last week. Now the folks at Deutsche Bank say gold is taking a beating from what they're calling a more upbeat view of world growth. Do you share their optimism about gold?
What I think has happened in gold is we had a huge bull market, and this is the viciousness of asset inflation. It shifts from one asset class to another. In other words, in the late 90s, we had asset inflation in the NASDAQ, then we had asset inflation in real estate until 2007, and then we had a commodities bubble in 2007, 2008, and in the case of gold, we had a very strong performance, as was the case for silver, until essentially 1.5 years ago, September 2011. And since then, we've been correcting. And I have argued in my report that the correction is most likely not completed. What I'd really like to see is a shakeout. In other words, that weak holders of gold sell because they believe that the price is going down, or because they get margin calls or whatnot, and that could knock the price off to, say, 1,500 or even lower, but it would then provide a very good entry point. I don't think the bull market in gold is over, but we can have big correction. In the 1970 to 1980 bull market in gold, when gold rose from $35 to $850, gold had peaked out in December 1974 at $195, and then it fell to $105. In other words, it was down almost 50% before it went up another 8 times. So if you can have a 40% correction in the 70s in the gold bull market, and by the way, in 87 we also had a 40 to 50% correction in stocks, but after that they continued to go up. So we can have a lot of downside volatility, shake out the weak holders, and then a continuation of the bull market.
Marc, anybody thinking about the long-term future of gold only has to listen to this great quote from you. As long as I have to look at people like Mr. Bernanke and Mr. Obama, I will always buy gold each month.
Yes, I think it's clear to me the central banks will continue to print money, and the governments will continue to have huge fiscal deficits. Let's say you look at the U.S. Officially, the fiscal deficit is now slightly more than $1 trillion. It was at $1.3 trillion. But that does not include the unfunded liabilities that are accruing every year. If you included the unfunded liabilities, we would be talking about a deficit of something like $5 trillion. And the same applies to Europe. And I believe the Western governments will simply have to print money.
Pretty hard for us, Marc, not to think of gold as something to speculate in. And I like what you're saying here is that gold is an insurance policy against the folly of central bankers.
Yes. I own gold, and I own equities, and I own real estate, and I own some cash, and actually some corporate bonds. I'm not suggesting that gold will always go up. I'm intelligent enough, and I've been working in this industry for 40 years, that asset prices also tend to go down from time to time. But given all the money printing and the debt explosion that we had, and the lack of fiscal discipline in Western governments about deficits, I think that I want to have some money in gold.
If you don't believe in gold, how about this stat, Mark, from the World Gold Council? Gold demand reached a record last year, central bank buying at the highest level since 1964.
Yes, we have buying by central banks, especially in Asia, Central Asia, Russia, and they have, of course, very large reserves, $11 trillion. So they want to diversify out of the US dollar, and so they buy some gold. Now, will this always continue? I think so, because the level of gold holdings as a percentage of total assets here in Asia is very low. So that should support the demand. But as you know, and I'm not an expert, and I'm not necessarily a conspiracy theory advocate, but there is a lot of talk that gold and silver may be manipulated, and that actually the central banks in the Western world, in particular the U.S. Federal Reserve and Treasury, may not own all the gold they claim that they own. Maybe they've leased it out. So, I mean, I just feel comfortable to own some physical gold, period.
Marc Faber, our guest here on This Week in Money. Mark, mining stocks have been beaten up a lot in the last year or so. Do you still feel there's potential in mining stocks?
Yes, but I have to say, you know, it's like if you have a technology boom, maybe 5% or 3% of new technology companies survive and thrive. In the case of mining, I can tell you the problem is that it takes a long, long time to develop mines, and is very costly. And during the time of exploration and development, you have no cash flow. And at the present time, the financing of mines is very difficult. In other words, I'm a believer that the mining sector is approaching an important low, but not every company will survive.
Marc Faber, our guest here on This Week in Money. Mark, a quote here from Business Insider that I think a lot of folks should pay attention to. You're saying, yeah, go ahead and buy gold, but don't store it in the U.S. The Fed took it away back in the 30s, and they could do it again.
This is my major concern for owning gold, that it could be expropriated. But I doubt that if you hold gold, say, in Singapore, Hong Kong, or anywhere in Asia, that they would take it away. Now, if they take it away in the U.S., as in the 30s, in 1933 specifically, they paid for the gold. But afterwards, after they had collected the gold, they revalued it by 30%. So the people that owned gold, they missed out on that revaluation. Today, I doubt that any government would just take the gold away. Mm-hmm. They would probably pay for it. Say, today they would pay, say, $1,600 an ounce. And once they collected all the gold, they might revalue it to, say, $10,000 or $16,000 an ounce. But I doubt that everybody will go along with this. I think in Asia, I have my reservations that governments would kind of take the gold away or collect it.
Sure.
In Switzerland, Europe, who knows, under the pressure of the U.S., they might do it.
Is it possible that they could even do something like that the way they did in the 30s? Is it possible they could do that today?
I think that governments are incredibly evil, and they will look after their own interest, not after the interest of people. And the problem for gold is that it's a minority that really owns gold. So it's always popular in a democracy to take away from the few owners something and distribute it to the majority. This is always a popular kind of policy. And under the socialist government we have now in the U.S., it's a possibility at some point. I think if someone wanted to own gold, a safer jurisdiction than the U.S. would be Canada.
Why do you say that?
Canada has a much larger mining and gold and silver and oil culture than the U.S. That they would expropriate physical gold, they would also have to expropriate the mines and so forth and so on. It would really bring a huge set of problems. And it would meet enormous opposition because most people in Canada, one way or the other, have investments in the mining sector.
Mm-hmm.
So I think that I would rather own gold in physical form, or say in something like the Sprott Asset Gold Trust or Platinum or Silver Trust than in the U.S. I think the U.S. would be the most dangerous place to own gold.
Marc Faber is editor and publisher of the Gloom, Boom, and Doom Report. It's an in-depth economic and financial publication. He's online at gloomboomdoom.com, and you can follow him on Twitter at gloomboomdoom. Marc Faber, thank you for your time, sir.
Well, it's my pleasure.
After the break, Jack Crooks on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band 40th anniversary Aloha Tour. February 23rd in Penticton. February 24th in Vernon. On sale now. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Jack Crooks is president of Black Swan Capital. He's a currency trader and investment advisor, and he publishes Black Swan Currency Currents. It's a free global macro and market newsletter. You can find him online at blackswantrading.com. Jack, it's always good to have you back on This Week in Money.
Good to be back. Thanks for having me, Phil.
In the latest Black Swan Currency Currents, you're posing a fascinating question. You're asking, are stocks increasingly detached from reality? And boy, did we get our answer yesterday, huh? Stocks falling the most in over 3 months, the VIX jumping almost 20%. The biggest daily gain in over a year. Why did all this happen yesterday? You only have to look as far as the Federal Reserve. So tell us what they did.
Well, the Fed is kind of jawboning some of the members of the Fed, suggesting that they may come out of this quantitative easing a little sooner than the markets expected. You know, the markets are all juiced, and the consensus is that the central banks, i.e. the Fed, is going to continue to provide the liquidity, and stocks are therefore remain elevated forever, so don't ever sell stocks, just continue to buy them.
Now, we know that Wall Street loves QE and zero interest rates. That's pumped a lot of money into markets, and now that the Fed is talking pullback, it looks like a little withdrawal going on in the markets today.
Yeah, it does. I think this has people concerned, and I also think some of the underlying fundamentals are still shaky, and who knows, maybe we see some conversion flow to that idea.
Jack, the message we've been getting from the markets so far this year says we're going to have some kind of a recovery, but you're wondering, and I guess a lot of us are also wondering, how much of that message is being distorted by, for example, this $85 billion in bond purchases? How much is that shaping what's going on in markets?
I think it is. I think it's hugely shaping what's going on in markets and really driving the consensus, as I said. It's a very interesting that we're finally seeing this year, the last several months, a disconnect between the commodities and the equities. And it used to be, risk is on, i.e. liquidity-driven markets, stocks go up, commodities go up, risk assets go up. But we're seeing that disconnect, and I do think that one of the concerns that we have, and I think other people are starting to have, is this idea that the real economy is not going to recover in the way that the stocks are priced for, i.e. the stocks are priced for a kind of a cyclical regular recovery in the U.S. But if you look at the underlying commodity prices, if there's some type of recovery in the global economy, it sure isn't reflected in there, and they're declining. Their prices are declining, which suggests global demand is very, very weak or tepid at best. So this idea of a cyclical recovery, and then we add on the idea that the Fed may take some of the juice away we could see some real conversion flow here, was what we have been expecting. Conversion flow meaning from very positive consensus on a regular recovery to, hey, maybe we need to take a look at this.
Let's take a look at the couple of the commodity biggies here, Jack. Oil down $4 a barrel so far this week to 93. Gold closing at a 7-month low yesterday. It's up slightly today, but are they giving us a totally different message?
I think they are. I think those are two that you really have to watch. I know people are saying that gold is a function of possibly higher interest rates, but I'm not sure if I buy into that either. I think gold is moving with the rest of the commodity basket on a relative basis, and as the U.S. dollar starts to appreciate, we're starting to see that correlation finally come into play again, where the strong dollar, weaker gold. But same token, oil, I think, is really the biggie, because oil is what is an economically sensitive asset here, and we've been short oil for a while in here, and we're starting to pay off for us. So we think that the oil markets, are really telling the story from an economic standpoint. And just one more thing, it's starting to move in line. We're starting to see copper break again. So we're starting to see two real economic sensitive indicators, copper and oil, starting to move to the downside.
Jack, what about the G20? It's finally finished after a weekend in Moscow. Central bankers saying they're going to refrain from competitive devaluation. Does any of that make you laugh?
Yeah, the whole thing makes me laugh. I mean, the idea that this all kind of sprang, this whole idea of this currency wars kind of sprang from of late, at least the last round, from Japan, effectively jawboning their currency and making it weaker. But the reality is, Ben Bernanke has been in the currency war since he started at the Fed, pumping more and more money out there. And it's very, very difficult in a world in which everybody floats against one another, i.e. the market drives currency values. Governments can't just wake up and devalue. They used to be able to do that in the 30s when they had the gold standard, and those were real currency wars. What we have here is just central banks that are really desperate to drive any type of domestic growth and have the spigots wide open, and we're seeing the negative impacts on the global economy. And it is kind of funny, since the Japanese yen has appreciated in value for about 35 years, and now the yen finally starts to weaken a bit. The Western governments get all concerned about Japan, and I think it's a bit disingenuous overall, that's for sure.
Jack Crooks from BlackSwanTrading.com, our guest here on This Week in Money. Let's talk about the big dollar, the U.S. dollar. You mentioned last time we talked a couple of months back that the dollar could positively surprise us in 2013. Looks like that's going on. The U.S. dollar trading higher this morning following yesterday's rally. The dollar index hitting a high just under 81. The future, Jack, of the greenback, so bright, apparently Bernanke has to wear shades.
I like that. Well, we've had a dollar call. We thought that the real sea change for the dollar was the credit crunch back in early 2008. And we thought that was a major global macro event that would be supportive for the dollar. And it's been a very, very choppy ride, but the dollar has moved higher and higher since then. But one of the things we've also watched is gold. When gold blew off to its new high, if it was a pure dollar problem, then the dollar would have made a new low, and it didn't. So we think there's some general support for the dollar. And back to this idea of crude oil, with the U.S. supplies increasing, and we're starting to see a lot of companies want to get access to cheaper U.S. oil. So we're seeing some foreign direct investment come into the U.S. That's positive for the dollar. The U.S. current account balance, because of the fact that we're importing less oil, is tending to improve. That's supportive for the dollar. And we're also seeing some companies, GE is the best single example, bringing all their appliance manufacturing back into the U.S. away from China. We're starting to see more and more of that. And it's an interesting phenomena. It's kind of surprising. In the U.S., we're all concerned that we're going to fall apart any day, given the policies going on. And there's some reason to believe that's true. But on a relative basis, and this currency game is very, very relative, and it's hard to get your arms around. The U.S., with the money flow back into the U.S., it generally supports the dollar, regardless of some of those nasty things still happening in the U.S. economy.
Jack Crooks, our guest here on This Week in Money. Over to Europe, the euro. Here's the ECB's Mario Draghi saying a while ago, Europe's economy set for a recovery this year. Today, the euro falling to its lowest level in 6 weeks against the dollar. Latest data, the PMI coming out, says the recession probably is going to drag on for a while. Sorry, Mario.
Exactly. Yeah, Mario, I think that's a bit of a pipe dream, kind of talking his book there, because the European economy looks like it's set to move lower. We're starting to see German trade numbers come off. That's pretty scary for the zone. We haven't seen any real rebound. And in fact, if you look at some of the inside, and I don't want to get too esoteric with this, some of the numbers, some of the labor numbers, in Italy, for example, they're becoming less and less competitive against Germany again. And that's been the core problem that's created this whole Eurozone situation. When the periphery countries can't compete against Germany in general, and they're all stuck to the same currency, it just creates a hollowing out situation, and the money tends to flow to the most efficient producer because they don't have the currency in order to provide that flexibility. So this problem is continuing despite everything that Mario Draghi has done, and it looks like we're going to continue this recession, as you said, and I think it's going to intensify.
Jack, let's take a quick visit over to Japan. The yen rising against most currencies this week, including the dollar. A report from the International Monetary Fund says we should not be worried about depreciation. And I'm paraphrasing here, but they say the Bank of Japan should grow a set and start worrying about deflation. You think that's a good concern, legitimate concern?
Yeah, to a degree. You know, again, it's a bit disingenuous because, again, the Western nations have been pumping all the money they can into their own economies to try and create inflation, and it hasn't helped. The whole monetary fiscal stimulus game seems to be a failure in this environment where there's so much debt. So I think, one side of their mouth, they're concerned about Japan becoming too competitive, their companies becoming too competitive if the country weakens too much. On the other side, they like the fact that the Bank of Japan is pumping out all this liquidity into the global economy, which helps support what they're doing. So they have to be careful with this. You know, it's kind of a quid pro quo. They don't really want the yen to weaken too much, but same token, they love the BOJ in the game because they still think liquidity is the thing that's going to get us out of this morass. And I happen to think they're wrong. I think it's a debt problem, and it's leading to some much longer term slow growth in the developed world economy, regardless of what happens on the monetary side. So I don't listen to what the G20 says too often, or I don't really take it at face value, to tell you the truth.
Jack Crooks from Black Swan Currency Currents, our guest here on This Week in Money. Over in China, the yuan falling against the U.S. dollar after the central bank moved the currency lower. Yuan has fallen 0.2% against the dollar. Is that a big deal?
I don't think it's a big deal, but it is interesting that China just recently, one of their top guys came out and said he really likes the dollar, that they've changed their view. The dollar's going to be around for a while and be the reserve currency. And I do think this is part of the ongoing strategy in China. They want their currency to continue to weaken, or at least not revalue their currency, which they were getting pressure to do. The reason being, you're seeing a decline in global trade in general, and they're fighting for that demand that's out there in the world economy. So the idea that the currency is weakening in this backdrop of a weakening yen and a strengthening dollar isn't a surprise, and they really do control that. So it's just, I think, a bit of a game that they're playing to help themselves.
Jack, let's jump back to Europe for a second. The pound firming against the dollar after data showed the UK government recording the biggest surplus in 5 years in January. And, of course, everybody excited there that Mark Carney, our former Bank of Canada governor, he's going to be there July 1st. And, of course, that's going to be sunshine and lollipops for the pound from that point on.
Yeah, good luck with that one, Mark.
Yeah.
Talking about walking into the fire there.
Wow.
It's the pound, it's bounced a little bit just slightly today, but in general the trade it's a stagflation trade. What we're seeing happening in the UK is, weakening growth and rising inflation, headline inflation, and now the Bank of England just announced that they're going to add more and more quantitative easing. So it's been kind of a double whammy for the pound, losing yield support and they're losing growth support at the same time. And a lot of rumors in the market that a lot of big hedge funds have shorted the pound and expect it to go even lower from here. So even some of these slightly good numbers start to be overwhelmed, I think, by this idea of the stagflation trade.
What about the Swiss franc? It's continuing, Jack, to track the euro. It's a little bit higher against the dollar. Switzerland is something that kind of is below the radar for most of us. What's going on with the Swiss franc? What's happening there?
Yeah, it is below the radar. I think most people in the marketplace believe that they've effectively pegged to the euro, and everything's going to be hunky-dory going forward. The big question will become, if we see another crisis in the Eurozone and the euro really comes off, can the Swiss National Bank maintain that peg? And I'm of one, thinking that given all the money that they've already put on their balance sheet to create this peg, a crisis in the euro, they're not going to have enough money, I think, to hold it where it is. So I think that's a trade that people need to watch. If the euro, starts to break again in a big way based on crisis, who knows? Berlusconi gets in or whatever. It could be anything to trigger this. I think one of the trades would be to go long the Swiss franc against the euro, and it's called a euro-Swiss cross trade. In that case, you would just sell the euro-Swiss, expecting the euro to fall and the Swiss franc to rise in value. So that's something to watch. You're right. It's been a sleeper, but it could really explode to be a very, very interesting situation.
Jack, Canadian dollar a little bit lower this week as America's number one trading partner. We obviously are affected by what's going on with the Fed, and we have to be careful watching what's going on with the loonie. You're pretty candid about what you think is the future of the loonie, and you say, in one word, down.
Yeah, we've been playing it to the downside, and it's been paying off for us very, very nicely and our subscribers the last week or so, and we've caught it a couple times recently. In general, it goes back to what we were talking about. The fading commodities in the background suggests that the global demand isn't there. We're still concerned about China's growth. We think some of the numbers have been falsified to a degree, maybe falsified too strong a word, or completely fabricated. How's that?
Hey, I like that.
In line with the new leadership. So I do think the fall in commodities in the background, and the numbers out of Canada haven't been that great. Manufacturing numbers lately have not surprised a bit to the downside. So in general, we're starting to see not only Canadian dollar, but just the commodity complex start to move down together in here, and to us that's a pretty valid trend when it's driven by the fundamentals.
Let's look at the other big commodity currency, the Australian dollar. It's more than a penny lower today after, of course, that Fed news. And we got to remember also that the commodities play a big part in what's going on with the Australian dollar, just like our Canadian dollar.
Yeah, pretty much the same story, but probably even more intensified, because on a relative basis, the Australian dollar has been a lot weaker than Canadian in here, and part of that is kind of a give back, because if you look on the upside, the Australian dollar had moved up so much more than the Canadian dollar had. So we're starting to see some of that premium in the Australian dollar. We always refer to the Australian dollar as the risk-on currency, meaning it moves the fastest when there's a lot of liquidity in the world and growth. It tends to be the fastest moving major currency. And when growth comes off, or there's a risk concern, it tends to move down the fastest. And we're seeing it play that role at the moment. But I think you nailed it. It's the commodities, concern in the background, and some of the hollowing out of some of the whole industry inside Australia with a very, very high currency and the demand coming off for commodities. We could see a real slowdown in that economy, and the Reserve Bank of Australia has warned about that. So in general, this trend, I think, makes sense with what's going on in the fundamentals.
Let's take a look at New Zealand, Jack, falling sharply after the country's central bank threatening to intervene in forex markets. Get this, the finance minister warning that trading the currency is not, in his words, a one-way bet.
Yeah, and it's looked like a one-way bet. The New Zealand dollar has been the strongest currency of the pack for a while here. But as you said, they were very, very clear that it's too strong. They're feeling the pressure on their industry, their manufacturing industry, with such a strong currency. You also had that little scandal with New Zealand dried milk tainted that went into China. And it's a small country, so things like that are important to New Zealand. But so I think you have a kind of a double setup in here. The central bank has made it clear it wants the currency lower, and the fundamentals, if this trend continues in the commodities, will also tend to draw down the New Zealand dollar, because it's one of the three what's called the COM dolls, commodity dollars: Australian dollar, New Zealand dollar, and the Canadian dollar, all driven in general by that commodity movement from a longer term trend standpoint. So we are short the New Zealand dollar at the moment. And just added that short this morning, in fact.
Jack Crooks from BlackSwanTrading.com, our guest here on This Week in Money. We don't often talk about Venezuela and its currency, the bolivar, but it's been devalued for the 5th time in 10 years. And you and I were chuckling about this earlier. Finance Minister Jorge Giordani says Venezuelans are behaving like nymphomaniacs toward the U.S. dollar.
Couple things to say. I guess you could say, wish our finance minister was that articulate, that's for sure. But I haven't heard currency trading described in those terms before, so that it is kind of funny. But yeah, I mean, just in general, the policies that have been instituted by Chavez, it's no surprise, that's becoming a command and control, economy, almost like the old Soviets. Yeah. And it's an economic disaster for the people there. It really is. So hopefully something can change.
Here's a real a key indicator for what's going on in Venezuela. The black market rate for U.S. dollars more than 3 times the new, quote, official level, unquote.
Yeah, and again, that's what happens in these these command control regimes. It's no surprise, and who knows? They may dig their heels in, and if it does, the currency just continues to go lower. So we'll just have to wait and see. Unfortunately, it's not a trade that most retail investors can get access to. But if there is some type of some political change in Venezuela, if something happens to Chavez and there happen to be some new regime, it would be the time to try and look at something like that. And again, it's tough to access, but there are some ways.
Jack, it's always fun to look around the various currency markets and see how really we are all kind of interrelated. What happens, for example, with the Fed affects all currencies in the world. Now, so I can better understand currencies, let me know how I can subscribe to the Global Investor. How does that work?
Sure. If you just go to our website at BlackSwanTrading.com, and you click on our various services, you'll find titled Global Investor. And it's only $99 a year, and it's a monthly summary of really all these global macro events that you and I talk about very often. And we also give ideas, using ETFs, exchange-traded funds, over a medium to longer term basis to trade these trends that we see setting up and as we talk about. So it's a pretty simple service, but we give a lot of information, and we think it's very valuable for our customers.
So what's coming up next for the U.S. dollar? What's the Fed going to do next? What do you see on the horizon?
Yeah, I'm not sure too much change from the Fed. I think one of the concerns is that, and it has been, I think we're going to find out that this recovery peters out. And from that standpoint, I think the Fed will stop jawboning about leaving QE. I do think as we see a slower growth economy become back into the mindset, you're going to see bond prices surprise back to the upside. Everybody thinks there's a bond bubble. So that's one of the trades that we have set up in Global Investor, in fact, that the shift in the consensus back to a very slow growth environment is going to rally these bonds. So it's a trade you can make using ETFs, and so that's one of the sleeper trades, we think.
Jack Crooks is president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at BlackSwanTrading.com. Hey, Jack, thank you. Always good to talk to you.
Thanks, Phil. It's great. I appreciate it.
Thanks to our guests, Marc Faber and Jack Crooks. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.